Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week. The Mortgage Voice with me, Jeff Barton, is available on demand, and on the air. Anytime you need to find the latest mortgage information. And by the way, there's a lot changing really quickly. So if you need that information, you can find us almost immediately on YouTube, where we upload the video version of the show each and every week. Just search for The Mortgage Voice, Jeff Barton, The Mortgage Voice, and you'll tune in to me this week, as well as about 800 other weeks in the last 8 or 9 years that we've been on the show. You can listen to the show on demand with your mobile device via any of our podcast partners, too, and Apple and Google and Spreaker and Podclips.io, Spotify, Stitcher, and more. Plus, we're also available on traditional radio in a number of markets. One of these may be yours. Inland Empire of Southern California, a couple of great radio stations there. Las Vegas, Nevada, Albuquerque, New Mexico, and of course up in Lake Tahoe at KTHO. And thanks again for listening to the show. Okay, inflation is dominating what's happening in the economy. Things cost more. And they want to have them cost less. So Fed is raising rates and will continue to do so until it hurts. And it has already begun to hurt many of the industries that we on the show talk about all the time, whether it's real estate or whether it's the mortgage interest rates. Now, mortgage interest rates, as everybody knows, follows the 10-year, and the 10-year itself, let me just see what it is. Okay, so the 10-year, just to give you an idea, during the first half of 2020, which was the first year of COVID, the 10-year was at 0.63. That's 0.63. Today, the 10-year is at 3.49. That's 18 months later. That's how fast things have changed in the economy, and as a result of the inflation that nobody seems to get a handle on. There's a lot of people wanting to place blame, and I put out a number of different, as everybody here who listens to the show knows, I put out information all the time, whether it's on LinkedIn, whether it's on Facebook, whether it's on Instagram, whether it's on any other Twitter, certainly YouTube and the radio stations and the podcasts. And this information that I put out, people always comment. And I love the comments. And I never get into an argument. I usually just try to rise to where I think people need to, be in terms of the information that they have in their head. I.e., it's not a Democrat, it's not a Republican problem. What it is an economy in a capitalist society that has gone through a long period of cheap. And I've said, look, you can buy all the cheap stuff you want from China, but it's not going to help you domestically build products here. Building products here, which is what's happening more now because supply chain is down, and people are going to have to make do with whatever it is that's locally made, locally sourced, all that kind of stuff. It's just going to cost more. Why? Because labor costs more here, obviously. So what the economy tends to want to do is to return back to where labor is cheap, and therefore things are cheap. Now, for people who have money, that's no big deal, right? I got money, maybe you have money, I don't know. But for a lot of people, especially people who drive, which would be where I live, everybody, it's out of hand, $7.50 for a gallon of gas. Think about that. You're paying $120 for 18 to 20 gallon tank fill up, whereby 18 months ago you were paying half that. That is a big problem, especially if you've got, obviously low end or lower end hourly wage people, whether it be $15 an hour, which is, I think, the minimum in a lot of Southern California. The show's produced in Southern California. We have a couple of radio stations, KCAA, KMET, in the Inland Empire, San Bernardino, and Riverside counties. Now, those particular counties and the county of Los Angeles, Orange County, Santa Barbara County, San Diego County, all these places are about $15 an hour, but there are many industries that have to pay way more than that. You go to a regular fast food restaurant now and you can't get service. You go to any restaurant now and you can't get service. Why? Because people aren't making enough. Or there's the big quit is what they call it, when 4.5 million people have quit their jobs and aren't coming back ever. So the demand on labor still is 2 job openings for every person available to work. All of this pressure on wages is what the Fed doesn't like, because what we would like to see is full employment at a 1-to-1 ratio at a reasonable cost. So therefore you would get inflation under control, because anybody who pays somebody more money today is going to have to charge their customers more money tomorrow. It's just a snowball effect, right? Now, I'm all for higher wages, and I'm also for less profits. But the problem in that, and we've seen this when we talk about oil prices, and oil prices, of course, are what everyone talks about when they talk about gasoline. There's a couple of components there, but for the most part, oil equals price of gas. So if you're spending $60 per barrel of oil versus paying $120 to $140 a barrel, well, obviously your price at the pump is going to go up. Now, there are those out there in the economic world, the economics professors, the people that work at the different institutes, the people that work at all the think tanks, the economists. They look at the problem and they see it as more than just a supply and demand problem. They see it as a restriction on the type of oil, the delivery of oil, and that's regulation and government, right? Or they see it as an issue of embargoes against foreign oil, whether it be OPEC countries or whether it be Russia during the current configuration of what's going on with the sanctions against that particular country. Money is what money is, right? And what I mean by that is most of the demand for products in this country is driven by the ability to make money. And that particular aspect, the ability to make money, the potential to make money, is what drives shareholder value for the big oil companies. So the potential of oil in the ground is what drives future stock price. And the stock price itself is kind of the bottleneck of what's happening with oil production. Why do I say that? Refineries in the U.S. are at the lowest point they've been in 30 years. So it means that during or before COVID, if you had oil from anywhere in the world, you could refine it quickly and more quickly than you can today. You can pump all the oil you want today. However, if in fact you can't refine it, nobody can put it in their tank and drive around. So it means that the bottleneck is really at the refining center of the process between drilling and driving around. Now, why does this matter? Well, it matters because it's the shareholder value by the demand that is created by less refining capacity. That's a problem. How can we change that? You can't. They're not building any more refineries. Matter of fact, they're planning to take more offline. So blaming or pointing fingers, you have to look at the system with which we live in the good old USA. It's about the bucks, the capacity to refine oil, the capacity for refineries to bring unrefined oil to you is such that it doesn't exist. It doesn't exist to the tune of where it was 24 months ago. So therefore, regardless of how much oil you pump, or how much you transport it, whether it's the pipeline that everyone complains about, or whether it's, the lack of push by whoever it is, whether it's an administration or a company to be able to pump oil, no. The shareholder value demands that price for oil be high. So therefore, it is high. And it is high because it is an artificial foundering of capacity to get oil to the gas pumps in refineries. Just isn't going to happen. So all these things that are going on about inflation, and we talk about inflation a lot. Why? Because it affects how much you can pay. If you're spending twice the amount of money on gas, and you're on a fixed income trying to buy a house with 3 or 4 people, that's going to kill a lot of the ability for you to buy gas. Now, we're going to get into rates very soon, because rates themselves are following in conjunction with the spike in gas prices. And this is killing the real estate market. 17 articles I read today about how the real estate market is turning around. So if people are looking for a house, I say wait, unless you have to have it today. People are selling a house, I say sell the house. Don't be silly. 6 months from now, you might not be able to get the price you can get today. I'm Jeff Barton. I'm your voice in the mortgage industry. Really appreciate you listening into the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. You know, the show is available whenever and wherever you need information, especially if you need it right away. Fit your busy schedule. Make it easy to watch or listen to the show. Find our episodes on demand from our website, themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice. And our Mortgage Minute weekly program, always available on YouTube in podcast form and wherever you get your podcasts, including Apple, Google, Stitcher, Spreaker, Podclips.io, Spotify, and more. I'm Jeff Barton. This is themortgagevoice.com, and I really appreciate it. Thanks for listening to the show. Okay, so what we do each and every week is we bring experts, people who really work in the business. As you know, we do a macro kind of portion when I talk about the larger economy and some of the things that are moving rates. But when we talk right about programs and things, we bring on account executives from great lenders, and Sonya Hadley from Ellerit is one of those people. Sonya, how are you? Thanks for coming on the show.
Hi, I'm doing well. Thank you very much for having me.
And thank you very much, too. Okay, so we've seen rates take a big jump. What's heading our way from the Fed? We're not quite sure. But in terms of programs and what you're doing over at Untitled Capital, could you just give us a brief breakdown, and then we'll ask a few other questions about some of the programs?
Oh, absolutely, sure.
Great.
Sure. So what we at Accelerate Capital do is we specialize in what we call non-QM.
Okay.
I'm not sure if your listeners know what that is, but
They
it's
do.
basically if you not quite fit into the agency or the regular conforming product, we have all kinds of products that weren't available even, let's say, a year ago. They came back. They were around before 2008. We're back into the environment where we can do asset documentation as far as your utilization. As far as a program, we can do stated, no income documentation, and we really specialize in investor products.
Okay, some of those investor products. Now, we have a lot of people that listen to the show who are doing those DSCR loans. Is that what you're talking about in terms of the investor loan?
Absolutely. We have the Investor Plus, and we have the regular investor loan. The Investor Plus, one of the highlights is you can put 10% down on an investment property. You don't have to show any income documentation at all. Your credit has to be decent. However, you can also, what they mean by DSCR is, as you know, if the property manages enough money and it covers the mortgage payment 100%, that's all you need. It has to be one. It can go a little lower to get the best rate. As long as it covers your mortgage payment 100%, that's it. That's all you need.
Okay, interesting. Now, figuring out that calculation, how does Accelerate do it? Do they go through what the appraisal says will be the rent value, or is there some other method that they might be using?
Yeah, I just did one. It's a multi-unit property, that's six units. We did get basically a commercial appraisal. They put down what they said the rent is in the area. However, we take the actual leases, add them together one by one, and do it that way. We'll use that as a compensating factor, what the appraiser says, but we actually look at what the property has been rented for or can be rented for.
Now, which I happen to like, especially when we're coming into kind of an unsure market, both in the equity in, and we may be losing equity if, in fact, the market turns south a lot more quickly. So making sure that the rents are being, are right up there, because do appraisals follow what the rent is, or do they follow what the rent potential is?
It's in the area. They use, like most appraisals, they use whatever the comparisons are in the area, rental comparisons.
I see. And that's, I don't know what in your area or this area that we're talking about, but usually there's a book or something that you go, and I'm trying to think where it is right now, that people can find out that information, because I know a lot of people who listen to the show are going, okay, fine, I have a building that I want to buy, but it's empty. So how do I find out what
You can look at, as far as a property, not commercial, but say a unit, or like I was saying, the 6 units that I'm doing right now. You can go on, say, even like a Zillow or something, and say, what would this rent for? There's a lot of applications out there online that can give you the basics. So it can get you in the ballpark for that. We also have, I just wanted to interject this, we have a new program for Airbnb. There's a company, and I'm not sure, again, if you've run over this, called Airbnb DNA.
Nope.
So if you have a property that has been a Airbnb, and they can show what it's rented for, because that's substantially higher than a monthly rent, right?
Right.
Usually it's at least double or triple what you can rent it for on a monthly basis. So we take it to that company and just make sure it's a cost that we incur, that it is the Airbnbs in that area are pulling that in, and we can use that for your DSCR. So that's really helpful with investors that are looking for an Airbnb. We can actually use those numbers. So that's a new little caveat we have.
No, I like that.
Yeah.
Especially
Airbnb, like I said, pretty decent.
No, I think that all those kind of helpful ways by which you can look at rent versus, a typical month-by-month or yearly lease. Yeah, if you're in the Airbnb business, you can make a ton of dough, and yet you're only renting it out half the time.
Absolutely. So bringing that on, we like it. A lot of our investors like it. Again, with only 10% down and no income docs, it's really easy for especially your investors that are looking pretty heavily, for something like that.
Okay, 6 months down the line, where are we going to be with both rates and how the mortgage market's going to be looking at that time?
Yeah, so I've been in the business almost 30 years, so I can go just on my past experience. I mean, we go up and down, and it's always going to come back. However, because of all of the issues we're dealing with, the recession, all of the stock market issues, the selling off of the bond that just happened. I mean, rates are in the 6s today for just a regular 30-year fixed or high 5s.
Right.
Yeah. So I think that in 6 months, I don't think we're going to go up into the teens. I think we're going to go up. We'll be right close to, 8-9%. And then after that, I think it depends on what the properties do. If we see it sustaining and staying level, then I think we'll be great. If they keep going down, obviously, what that looks like. I don't think so, but I live in Southern California where a lot of the properties keep their value pretty decent, especially on the coast. So I don't really see that in our area, but I do see the rates going up further.
Yeah, I agree with you.
Again, they'll come down. Yeah.
No,
I don't know if you agree, but that's my philosophy. Yeah.
Yeah, I don't know. I've been so wrong so often. I have no problem being wrong again. So I think I don't know about 8 or 9%, but I certainly think by the end of the year we're going to see close to 7%. Heck, we've gone up 3.5% since the beginning of the year this year. So,
absolutely, yeah. It's crazy.
Yeah, it is crazy. I mean, and I think the cooling off of the real estate market is going to happen way faster than most people think. I mean, what we've seen is like warp speed on a lot of this stuff, especially since COVID has sort of petered out. I mean, it's there, but nobody's really talking about it or dealing with it here. I mean, we're not China. We're not locking down cities. People are out doing what they got to do. If they get sick, they get sick. But for most of us, this real estate market is really flipped. Inflation is making people, I guess, take their eye off the ball. But mortgage rates, the way they are today, I think it looks to protect the lender, because I'm not sure the lenders are behind 100% in the equity that's been going up in the last 3 years. I mean, heck, it's almost gone up 50% in 3 years. That's insane.
I mean, I personally bought a property, and I'm surprised at how much it has actually went up. I'm very surprised how quickly. But I think we're going to level off. I don't think, like you said, a lot of lenders are not going to actually believe that there's that much equity in every property. So they're a little more conservative, and they question a little bit more to make sure they're not just hanging out there, when something happens and then they're stuck with a whole portfolio of loans they can't sell.
Right. We did that before, and it didn't really work out well for a lot of us. So.
That was bad. That was really bad. Just briefly, we also do ITIN, which means you don't have a social security number. maybe you're up from a different country, but you've been here a long time and you have an ITIN, we can do that. We can do foreign nationals. Again, the asset utilization, I think, is a great program. I didn't have that a few years ago when I had a client that could have really used it. So
Right.
I like all of those options for us.
Sonya, can you shout out a way by which people can get a hold of you? This is Sonya Hadley from Accelerate Capital.
Mm-hmm. Sure. You can email me, which is great, which is just shadley at acceleratecapital.com. And Accelerate spelled EXCELERATE. Or my phone number, 949-201-0747. Always got cell phones nearby.
Excellent. Sonya, thanks very much. I want to have you back because you're a great guest, a lot of experience and knowledge, and certainly the products you offer over there at Accelerate are really primed for this type of market. Thanks very much for coming on.
They are. Thanks, Jeff. Talk to you soon.
I'll talk to you soon. That's Sonya Hadley again from Accelerate Capital. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. The show is available whenever you need information, even if you need it right away. You know, everybody's busy. You got the information, you need the information, you want to buy a house. If you want to watch or listen to the show, find our episodes on demand from our website, themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice, and our Mortgage Minute and Weekly program is always available on YouTube. Shoot, we got 800 shows there. We've been on YouTube about 8 years. Wealth of information, topical, and also if you want to see or hear any of the guests again, go to themortgagevoice.com. That's our website. And if you go there, sign up, sign in, and we'll give you notifications every time we have a new show. Anyway, thanks very much for tuning into the show. Okay. I bring to the show all the time people in local areas, especially where the show is. As everyone knows, we're out in Las Vegas, Nevada. I've been out there for a number of years. And the people there do a great job at bringing information that we have on the show to their audience. And joining us is the sales manager. Is that right, Mark? Are you the sales manager?
They changed the title. Same responsibility, general manager.
Oh, that's better.
On their personality now.
No, okay, very good. This is Mark Hayes joining us from KSHP. How are you, Mark?
I'm doing wonderful, Jeff. Thanks for having me.
Thank you very much. Okay, radio market and radio business itself. How has it changed during COVID? Have you heard from more people that they listen more often? Is it less often? What's happening with the radio station?
Well, what's happened with us, Jeff, which is kind of been a blessing, that we were able to maintain our on-air frequency as far as during the pandemic. We never lost any airtime. We went straight through. We had some times where people were at home and working from home, but for the most part, Jeff, we were able to sustain our continuous on-air shows, all the live shows, and even the pre-recorded shows that we do. Everything, we'd never missed a beat during the pandemic, and now what we're facing is trying to get back up the hill. We were at the top of the hill with businesses and sponsors, and for 2 years we kind of was on the bottom of the hill, so now we're inching our way back. And it's a slow process, Jeff, and we're happy just to come in and everybody has a smile and everybody got a place to come to work.
No, I appreciate that. I think what we're seeing in our business is there's a change, a very large change. It's happened both in the mortgage interest rates, which have gone up over 6% now, which at the beginning of the year were 3%, and we've also seen inflation eating into everybody's paycheck. Do you see recession? I mean, what are your customers telling you about their businesses?
It's a lot similar. I mean, gas prices, inflation, food costs.
Right.
And what I'm seeing as I go on the radio 6 days a week. I mean, I'm on the air almost every day.
Wow.
And so what I'm seeing is less calls, because what we do is the talk side of it, and then we also do the shopping side. So we're seeing less calls because people are having to choose between, do I go out to a restaurant or do I put gas in my car?
Yeah.
I think the choosing, and people are working check to check, so you have to decide, do I feed the kids or do I go to see a show?
Right. No, I agree. And I think Las Vegas is a city where there's a lot of working people. Now, as many of us go there for vacations and to enjoy our time and spend money, the majority of the people who live there don't live that type of lifestyle. And every dollar that they spend has to be a choice, right? Entertainment, food, right.
It has to be accounted for. I mean, you know, the summer months, of course, it's the hottest months.
Yep.
So people, when they come to visit Vegas, vacation time and things like that, Vegas is open, but the majority of the people that live here, we don't visit the glamour and the glitz down on the Strip. We stay as far away from it as possible. Only time I go on the Strip is if somebody from out of town,
right,
a friend or family member are visiting. Now they want to kind of be entertained on the Strip, but you stay away from the Strip, and those are mostly for tourists. And you know, they have local casinos and things like that off the Strip. So, you know, most of the people that do come in town are, you know, locals and people from other states.
Do you see people spending as much money when they come to town? Has that ever recovered? Do we see casinos at, you know, full capacity, or is it still down?
I think what I've seen in the people or some of the relationships that I have with some of the casino marketing directors and some of the sales coordinators that I work with, what we're seeing is a trending into our sports now.
Okay.
We have a people love their sports.
Yes, they
right?
do.
And so what we're seeing now is a lot of people coming to Vegas for sports first and gambling second, which that's great for us because instead of a person staying 1 or 2 days, now they're staying 3 or 4 because they want to see their favorite team play hockey or their favorite team play football or their favorite team play basketball. Or,
right.
Is there a, you know, a lot of the vacations now are geared around the sporting events that we're having. I mean, we just recently hosted the Pro Bowl, we hosted the NHL All-Star,
right,
and we hosted the NFL Draft. So,
yeah,
that attracted a lot of people.
Well, I think it's been a, you know, kind of a hidden secret that sports in Vegas is really exciting. If they can build a dome baseball stadium that have a baseball team there, and I know they're looking for a basketball team. I was speaking to some of the people who own the Golden Knights hockey team, and they were talking, oh, no, we're not going to let basketball in here. No, they'll have to build their own stadium, which would be great because the city, I mean, it's a big city. It's 2.5 million people. This isn't a little place. There's tons of people who would definitely support the team. And when I went to the hockey game, I was shocked at how into it they were. I mean, the costumes they wear, it was pretty amazing.
Oh, yeah, it's a production.
Yeah.
It's definitely a production. I mean, and what I've seen in some of the people and some of the meetings and some of the places that I've been and talked to people, that has gotten us back into, okay, now Vegas is the sports capital of the world. We used to be the entertainment capital of the world. Now it's sports entertainment. So you're going to come to Vegas now and not only spend, you know, a couple of $100 or $1,000 on tickets for a sporting event, and now you got to pay for your hotel. Now you got to pay for food. Now we just created another avenue for revenue.
Yeah, and it's sustainable too. I mean, I think if you have a sports team, pretty much you're going to guarantee that during those days that they're having games, you're going to find people in the seats, which of course spends money. Even in a down cycle, people are going to go to a hockey game. They're going to go to the football game. Absolutely. And with the new coach, the Raiders are looking good.
Yeah, and that's really has helped. I mean, you know, if you had asked me 10 years ago, Jeff, would Las Vegas ever have a professional sports team, I would have told you no.
Right.
And now here we are with, and people don't know, we even got a soccer team that's
I
affiliated
saw
with
that.
the MLS.
Yep, I saw that.
We got the A's, AAA team, the Aviators, that's here. So we're like right on the cusp of having all 5 professional teams, including soccer, and we just got lacrosse, which is led by Greene and his group.
Right.
So they're going to have a professional lacrosse team here. Nobody don't know we got a professional arena football team here that just
have for years. Right.
Yeah, so you know, you start to factor in all those different sports where people are coming to town, and it's like the more we can offer, the more people want to come.
Tell me a little bit about the ad revenue, how the station makes money, and is there money anymore in radio in terms of advertising revenue?
Well, our station is very unique, Jeff, and you may know this.
I do.
Like I said, we have a variety of different shows that we host, whether they're live shows, 5-day-a-week shows, 1-day-a-week show, whether it's a mortgage show, whether it's a health show. And then we also have a real special show that we have. It's like QVC, but It's the radio shopping show.
Right.
And that blends with our sports and our real estate shows. So we have, again, it goes back to the sports and Las Vegas revenue. So when people listen to our station, okay, I can get some discounted show tickets. I can find out about how to get in contact with somebody for the mortgage, and I can also listen for sports on KSHP. So we want to be that one-stop shop,
right,
where they can listen to everything. And it's not a lot of other stations. They may be bigger stations, but they don't really offer the same quality of content, the quality of what we offer, especially with our shopping show. No other station does that, Jeff. So that, kind of makes it unique. It's on the AM dial.
Yep.
But that still is where people go to listen for sports and talk.
I agree. Listen, we're up against it, but could you shout out a way by which people can get into hold of you if they want to either get involved with the station or maybe bring a show to the station or just learn more about it?
Yeah, definitely. You can always reach me on my email. It's Mark, and that's with the M-A-R-K, spelled no C, with a K, H-A-Y-S, no E. So that's Mark Hayes at KSHP, and I patented this a couple of years ago. It's cash with a K, SHP. So cashsavinghappypeople.com.
That's excellent.
And so you got my email, you got our website, you can always check it out again. We are home of sports and talk. And I got to tell you something, Jeff. I'm great you're a part of our station because I will put our programming up against any programming here in the Las Vegas Valley right now. Even though we're a smaller AM station, some of the content we have is second to none in this town. So if somebody wants to advertise or if they want to be a part of a great show, have their own show idea, you can reach me at, again, Mark, M-A-R-K, H-A-Y-S, the @ symbol, and then it's KSHP. If you forget that, it's the K, S, savinghappypeople.com. Send me an email, and I'll get you some prices and rates, and it's very affordable to be on KSHP.
Mark, thank you very much for coming on the show. I do appreciate it. Love the update, and we'll talk soon. Thank you.
Thanks, Jeff.
Thank you very much. That's Mark Hayes from KSHP. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Hey, check out our website at themortgagevoice.com. There you can find our latest on-demand episodes of The Mortgage Voice, information about our guests, as well as their contact information. You can also read my blog, of course. Always read the blog, which keeps you updated with the very latest in the mortgage news. Check it out. Bookmark us. That's themortgagevoice.com. Okay, great. So we're kind of all over our listening area today. We've been everywhere from Southern California to Las Vegas, Nevada, and now we're going to get down to Albuquerque, New Mexico. Richard Greene, who has always been kind enough to come on and talk to us about what's happening in that market from New Mexico Mortgage Company, joins us again. Richard, how are you?
I'm doing great, Jeff. How are you doing?
I'm okay, just trying to wend my way through whatever this market is, but I don't see it ending anytime soon. Hopefully the rates won't continue to go up.
It's been a challenge. As so many of our customers and clients, I am not that old, but I remember my mom sold real estate in 1980s and early 80s, and I vividly remember when rates were 18 and 19%. So I'm not justifying it or putting anything to perspective, but they'll come back. It'll be okay, is what I'm trying to let everybody know. It stinks, and it definitely really hurts folks and buying ability, but it's not here forever, is my point. So there is hope here.
Okay, so tell us a little bit about the real estate market. Obviously, it's more of a purchase market, way more of a purchase market now than it was even 6, 8, 10 months ago. What are you saying to your clients, and are there still buyers plentiful in the Albuquerque market?
So there are, but we have, of course, a limited supply of
Right.
homes on the market. So Albuquerque, for the first time ever in its 300-plus year history, we have a median house price of $340,000.
Wow.
Which is really, Albuquerque's always been the tortoise and the hare. We've always been slow and steady, but that's practically, we've had a huge gain since 2019. Those 3 years, the pandemic has been good for real estate values in Albuquerque.
Yeah, no,
and all over, I'm sure.
Yeah, no, I agree with you 100%. And we watch Albuquerque because it was one of the fastest, not like fastest is a terrible term, but it really has grown in terms of the equity in each and every home. Even though for most of us, especially in a place like Southern California, look at $350,000 and say, oh, okay, that's pretty cheap. But for your market to go up 100, right, exactly. It's relative, right? So you probably get you get a lot of influx of California buyers, people from other states who, look at that market, and it's a terrific market. Nice city, good people, weather's friendly. So dearth of houses on the market, meaning there aren't any. Do you see any danger in that the equity that's been built up over the last few years, if we have a recession, is going to come down some?
I don't believe so in the Albuquerque market compared to the 2008, of which there was a lot of supply. There was a lot of cheap, easy money that a lot of people got in over their heads. Builders can't build fast enough. Lots can't be developed fast enough. There's infrastructure issues. I mean, in Albuquerque proper, I really don't see that equity being lost even if we come into a recession, based on the economic factors that we have of just that we're not quite on an island here, and we're nowhere close to ocean, but we have the Sandia Mountains to the east. We have Kirtland Air Force Base to the south. We basically have the Sandia Pueblos and the Native Americans to the north. So we can only really go west as the city grows, but with that is infrastructure issues and further away from the center of town, and it has been growing in that direction. But with all that said, my prediction is we won't lose any of this appreciation that we've gained here over the last 3 years.
I'm sure that's music to most of your homeowners' ears.
It really is. It really is one of those markets where we kind of have been undervalued for all these years.
I agree.
And with the pandemic, we had so many people discovering they can work from home, and so we've gotten a fairly good influx from surrounding states because we really are affordable. Just a cute story. I didn't even help the person do a mortgage because there wasn't a need for a mortgage because they sold their 800 square foot in California for $1.2 million.
Oh my gosh!
They come here and buy cash.
Yeah, sure they do.
So they love it here, but but that we got a lot of that has helped the values. It might have not have helped us locally as a community for first-time home buyers, but it has helped overall the bigger picture.
Okay, programs. What is the hot program, or is it just a smattering of everything? Are you non-QMing it?
It's a smattering of everything in arms. Adjustable rates are back.
Right, I saw that.
Well aware. We're educating, because that's what this is. For so many years, I have not even. So we are really educating on what an adjustable rate mortgage is.
Right.
How the mechanics of it, because so many people, of course, are so used to the 30-year fix. They want a 30-year fix. They've been told to only ever get a 30-year fix.
Right.
And scared to death of an adjustable. And really just been visiting and educating and explaining. With anything in life, there's a pro and a con.
Sure.
There's definitely a pro and a con, but really educating on how it works. And some folks have actually really taken hold to it and understand it. It's like anything. As long as you understand the program and what you're getting yourself into, you can manage for it. You know the rules of the game. You can manage to it.
Well, I mean, in terms of a 5-1, let's say, you might be talking a point less in terms of the overall percentage, but you're only got a fixed rate for 5 years. So explaining what that is and what it means and what the adjustable cap is, all of that, you're seeing some of the buyers sophisticated enough to understand it, or is it just whatever the lowest payment is?
No, a little bit of both. Because now, with home prices smidging up as they are and the demand for making an offer potentially over list, that little bit of reprieve, even on a 1% payment,
right,
will help them justify being able to have home ownership today rather than stay in an apartment. And the quality of life that comes with home ownership. I mean, there's a lot of responsibility. There's a lot of don't ever want to get in over your head.
Sure.
But valuing what the benefits of home ownership are, and so I've had clients truly understand it, and some people are definitely a little worried about it or scared about it because nobody can control the future and just don't want to get in over their head. Is very concerned about getting in over their heads, when other folks really understand it and their plan is, well, the kids are going to be graduated college within that time, or my job's going to probably transfer me within that time,
right.
and
That's
they're
right.
okay with it.
Right.
Yeah.
I think that's true. I think if you've got a good handle on whatever your time frame is, and then on the other side, the prepayment penalties on an ARM product. What are there any? Is there insurance that you pay?
I am not familiar with other states, but and it probably carries over. But on a residential mortgage in New Mexico, it is illegal for a prepayment penalty. So we don't have
on a first mortgage. Yeah, right.
Yeah, on a first mortgage. So we don't have any. So there are no prepayment penalties to worry about or to be concerned about.
Oh, that's excellent. Listen, we're up in the last minute. Would you let people know how they can get in touch with you for a great person down there in Albuquerque Market?
Absolutely. So my name is Richard Greene. I'm at New Mexico Mortgage Company in Albuquerque, New Mexico. You can call me directly on my cell phone, 505-228-2610. You can also find us on the internet at NM, the abbreviation for New Mexico, nmmortgagecompany.com. Thanks.
Richard, thank you once again. Great information, by the way. You really got your finger on the pulse of what's going on down there, and I really appreciate it. I know the listeners do too. Thanks.
Thanks, Jeff.
Okay, thanks, and we'll talk.
Soon,
we'll talk to you soon. That's Richard Greene from the New Mexico Mortgage Company. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Hey, check out our website at themortgagevoice.com. There you can find the latest on-demand episodes of The Mortgage Voice, information about our guests, as well as their contact information. You can also read my blog, which keeps you updated. Very latest mortgage news. Check it out. Bookmark us. That's themortgagevoice.com. Okay, so we got into a little bit during the first segment that I did about oil and inflation and some of the problems that we have based on the kind of economy that we run in the U.S. and how difficult it is to switch from one gear to another gear. There is a push-pull against, should we fuel growth or should we, kill inflation? And I think there's a great majority of us who say, killing inflation would be good. I don't want to spend $10 on a gallon of gas. In California, we spend that much anyway, but still, for the rest of the country, let's ease the pain there. So we're always in that conundrum, I guess it is, where what are we supposed to do? And I say we, I mean in the financial section of the economy, which really rules what you buy and sell each and every day and how much you pay for it, whether it's the Fed or whether it's the Treasury or whether it's local state government or federal government in terms of regulations and rules and how prices get driven upwards. There's always a push on one side to get rid of a lot of that and always a push on the other side to say, no, that's what we're saving for. Okay, so let's get into a little news to use about some of the general aspects of what's happening in rates for your mortgages. And I want to talk a little bit about that right now. Let's see, the 30-year fixed rate at 6.28. Okay, the last time we saw 30-year fixed rate loans at 6.28% was in 2008. Now, anybody who was around in 2008 remembers that time when the world financially almost imploded. And it almost imploded specifically because of bad real estate loans. Bad real estate loans, signature loans, overestimated value. There are so many different ways that you could describe what happened. But 6.28%, that is one heck of a rate. I mean, for people who have been shopping for a house over the last month, you've probably seen this number go up almost a point and a half. Now, what does that mean? If it goes up a point, every $100,000 you got to pay another $100. So if you have $500,000, you just increase your mortgage payment by $500 if you didn't have a mortgage last month versus this month. That's a lot of money. That's $6,000 a year. You know, over the course of 10 years, $60,000 over the course of 30 years, which is most mortgages in that particular range. Well, you can figure it out. It's a couple $100,000. That's a lot of money. And a lot of that is interest. Interest payments get paid out first, as everybody knows, on an amortized loan on 30 years. So it's very expensive, or more expensive now. Now, the good thing is we are seeing some loosening in major cities around the country, a lot of smaller cities too, as to the real estate price hike. We are seeing many cities, as a matter of fact, 25% of the listings have cut prices nationally. We had this same number about 3 weeks ago at 10%. So we've seen a rapid reversal of what was happening, or what has been happening is happening, in terms of price appreciation, to whereby we're now seeing prices being cut that are listing. I know in my own area there are a number of listings that I confer on, and certainly to my loan officers. I work for Malibu Funding, 79620 is their NMLS number, and they, in talking to my everybody that works at the company, saying, hey, look, this real estate market might turn really quickly. In 6 months, you may see a drop in value as opposed to an increase of 3 to 5%, which is what we've been predicting through most of the first half of 2022. Okay, so let's get to a couple other things. The Fed raises rates. Of course they do. The short-term rates are continually, you know what? In order to quell inflation, they say that short-term interest rates have to match or exceed whatever the inflation rate is. So if the inflation rate is 8 or 9%, guess what? Short-term rates have to be 8 or 9%. If that happens, you're not only going to see inflation stop, you're going to see a recession, a big recession. So they're trying not to do that. Some of the other rates that we're talking about for mortgages in general, we talked 6.28 for the 30-year mortgage. The 15 years at 5.45, the FHA is at 5.75, Jumbo is at 5.25, and the 5/1 ARM is at 5.50. Now, these rates are really, I haven't seen these rates in so long. Just looking at the numbers, I'm thinking, oh my gosh, this takes me back to almost when I first got my first mortgage. Which was, of course, everybody knows who listens to the show, it was 8.75% back in, the 90s of some time. And we were happy to do it, happy to pay for it, because the rates had been coming down. So that was a come down price for us. This is a raising price. And for people who are looking, first-time home buyers, people looking for step up, or, now you're going to be looking to rent, even though rents are so high, or you're going to be looking to hold on and maybe, remodel. Those are the things that people are thinking about now. And we've seen, what does this say? Okay, here's another number for you. 82% of originations come from purchase. 82%. A year ago, it was the flip. 82% were probably refinances. Why? Because obviously the rates were like in the 3s. Now they're in the 6s. That's 3.5% in 6 months. It blows my mind. And when I talk to professionals, we all just sort of go, oh my gosh, this is happening. Yes, it is happening. And what can we do about it? Well, nothing. What you can do about it is try to prepare your borrowers and prepare your borrowing your borrowers for whatever the market is now. Okay, one of the things we can do is look at your finances. People who are looking at their finances now saying, hey, look, we're spending more money on gas, on food, on all necessities, rent, whatever it is that mortgages that you're paying. How can we get more of a control? Because during the boom years, which I would say COVID, 2 years, 2020, 2021, were the boom years for a lot of people. They got free money from the federal government, plus mortgages and housing, all this stuff. Mortgages were cheap. Housing was rising in cost and value. So a lot of people thought that those were good times. But now you have to control your finances. I'm going to give you 7 things you can do in order to just do that. First thing you have to do is assess your situation. You have to look at what you spend. You have to look at what you make. You have to see where you can cut and make the cuts. Make the determination and make the cuts. Number 2, you need to cut spending. Obviously, there isn't a business in America right now who isn't cutting spending, looking for ways by which they can lower the cost of doing business. Now, why? Because you want to stay in business. The last thing we need right now when we have an employment issue anyway, i.e. too many jobs and not enough workers, is to now start laying people off so people start to panic. No, we need to cut spending. Number 3, negotiate debt forgiveness. Let's say you're one of these people who have driven up their credit card debt or have bought something that right now doesn't look like such a great investment. You have to revisit the people that you owe money to and ask them, see if you can get a reduction in either what you owe, the percentage of what you pay on a monthly on the interest charge, or some other way to get out of that particular debt. Number 4, you have to put extra money to the debt. So let's say you got a side job. Let's say you've got some extra money. Let's say you got $50 extra a week. You have to put that money towards buying down your debt. 1, it's going to help your credit. And 2, it's going to put you in a much better position if times get worse. Number 6, is it 6? 1, 2, 3, 4. No, number 5, a financial journal. I did this when I was 21 years old. I didn't know where my money was going. I just know I was broke all the time. So you get a financial journal and you write down what you spend your money on to the penny. Do that for 2 months and you will have much better control of your finances. Number 6, use cash. Why do I say that? Because you control cash much more easily than you do credit cards. Credit cards, you slap them down, you don't think of the bill till the next month. Cash, you either have it or you don't. And number 7, listen, change isn't easy. Everybody knows that when you're doing something, it's just not that easy to make changes, especially wholesale changes in how you spend money and what you have to be paying attention to. It's a family thing if you're a family. Singularly, you have to do all the steps that we talked about previously, but you've got to get control of your finances, and the only way to do that is all these steps and to understand that the change that you need to do is not easy. Give yourself a break, pat yourself on the back, and get to work. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show this week, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.